Okay, guys, welcome back. We just got back from the CBOT, and what we want to do now is this morning we had Ben Lichtenstein coming in. You guys know about his squawk service and talking about kind of what the things that he sees on the floor. And now, and many of you guys met Pat last night. He's from Mirrors Futures. Last night at the hospitality suite, and Pat worked on the floor for 5 years, and we're just kind of bringing him in to kind of share kind of some of his stories and from the pit. Tell you a little bit how it works, from what he's seen as well. Some of the things will be similar to what Ben said, but then also too, Pat had a more unique experience of actually being on the floor doing trades, whereas Ben is kind of sitting back and kind of observing as what's going on. So without further ado, let's welcome Pat.
Pretty much everything I'm going to talk about relates to the S&P pit, because that's where I was for 5 years. So it all relates. Everything you saw at the Board of Trade today, the same thing really applies. The only difference between the Board of Trade and the Merc is, for whatever reason, the Board of Trade says sold when they mean buy them. They just say sold, and it means buy them or sell them. Other than that, it's all pretty much the same. A quick overview of how it works, who the players are. When you walk in, you're going to see a pit. You're going to see stairs that go up and then stairs that go down in. Now, on the edge of the outside stairs, you're going to have gold coats and their clerks, and they're going to be standing there doing this stuff, arbing all day, and what they're doing is they're talking to the people that are on the phones, telling them where the market's trading. And immediately behind them will be the broker, which is where I was. And right in front of them is a rail that separates basically the paper, the customers, from locals. Locals would be anybody that's trading their own money. Let's see. Pretty much, did Ben go over all that stuff?
A little bit. One thing that might be interesting too, because I know a lot of people are asking Ben. It's they're kind of curious, how do people, why does somebody go to the floor and stuff like that. So you might talk a little bit about how you got involved. What got you into the floor, and your process starting out,
your sexual preferences.
Gotcha. Well, I started on the floor. Let's see, it's pretty rare for a young guy to come in and immediately become a member, and a lot of it is about who you know, how long you've been there, how much money you have, this and that. I was brought in for computer skills because I was going to be starting to help Timberhill and Interactive Brokers take electronic trading and bring it over to the U.S. So I was there with a handheld, which basically was a wireless network, and that's how I received all my order flow, versus you'll see runners on the floor that carry tickets, and they'll hand them to brokers, and the brokers get in the pit, and they use cards and paper. You'll see paper all over the floor. Whereas we were completely paperless, electronic, and the first ones with handhelds a little bigger than this, but basically that was the gist of it.
So when you first had the handhelds, were people making fun of you or cussing you behind your back? Or?
Oh, on the floor. As soon as I got there, I walked in out of college, and I was immediately called every name in the book. You're putting my kids out of school, and my wife can't eat because you're here, and you're taking my job. And to me, I was like, I have no idea. I just graduated from Ohio State, showed up. They told me to go to the Merc, handed me a computer, put me in a coat, trained me how to trade and use all the hand signals, and next thing you know, I'm the worst enemy for just about everybody down there. So pretty much you can see the results of that. You can see why now, because electronic trading basically took all the volume out of the pit and put it on the computer, and for a good reason. From a little bit about how it used to work. I would get an order, say I had an order, I was working an order to sell 20 at 2 even. So I'd be in the pit standing there, 20 at 2 even. Standing there offering. The guy on the other side of the pit, he gets an order to buy him. So he's going to look at me. He looks over. He's doing one of these, buy him. I'm like, oh, yeah, 22 even, 2 even trade. I call him the trade. Move on. Stand around like this, wait for another order to come in. I go back to check the trade. I wave at him, checking. Sold you 20 at 2 even. He's like, what do you mean no? We're trading 4 even now. I didn't sell those to you? He's like, no, I traded with him. I'm like, okay. So then you just go back to the market and you sell it. Those are typical out trades like that happen pretty much all day long. So the safeguards go, you check with the person you traded with, just by using the little hand signals, checking, I sold you 20, it's good.
Here's what I would have got. No.
Closing one.
Pretty much, it was a little more, if it was big enough.
Yeah.
There were fist fights, it was pretty common to see people get into a pushing match over a mistrade, a stolen trade.
So now if there was an out trade like that, would it be sometimes would some guys split the difference, whether it was a winner or loser, or it was just hosed?
It depends on what happened in the case. Usually they split it because they happen so often. Depends, in this situation, I'm the guy with the computer. They'd be like, yeah, no, you got nothing.
Okay.
Those are yours. Eat them.
Yeah.
Take care of it.
Okay.
So basically then we're writing a check to the customer because I gave the customer a fill and said, you're good. Actually, in the example, I said the market went up to 4 even, so they'd be happy because they just got a better fill. But if you look around the S&P pit, you're going to see a lot of guys that are clamoring to be right around the front edge of the row there, next to all the brokers. And that's because basically when you get orders, it's going to be easiest to trade with the people right in front of you. Now, to get that spot, you have to be able to trade, for one, to make markets, and you have to have experience. A new kid off the street isn't going to get in. They're not going to be put right up front on the rail. So really how it works is, may or may not be right, but if I get really busy and the guy behind me is telling me, buy 20, sell 16, buy 32, sell 28, I'm going to grab the guy right in front of me, sell you 48, buy 64. What's next? Okay. What's here? What are the prices? What's here? It's 1/2 bid at 2 even. I sold you 1/2s, I bought 1/70s type of thing goes on. So it's really quick, and the guy's right in front on the top step. They get a huge advantage. But as I said, all that kind of changed when the computers came around, because now the markets are a little tighter. You can get off size now in the E-minis. So it'll be interesting to see. I haven't been down there for a while, but to see who's still there, how much paper actually goes into the markets through the floor, and what the firms are really doing. It used to be there were like 3 or 4 different types of traders. It used to be you would back somebody, put them in the pit because they were just big. And the bigger you were, the easier it was for me as a broker to see you and to trade with you.
So you mean like physically?
Physically,
like
yeah, 7 feet tall.
Joey Donuts kind of thing? Yeah.
Just tall. So there was one firm in particular, 815, I don't remember the house name, but they brought in 7 guys that were just super tall basketball players and put them all over the pit. And everybody thought, that's it's not going to work, never going to work. Immediately, what do? I can see the guy going like this. I'm like, hey, Reggie, buy 2. Hey, Earl, sell you 2. They're up here, everybody else is down here. I don't want to be like between you two. I'm like, hey, you 2.
So Priyanka probably wouldn't do too well.
No, there were about 3 women in the pit when I was there, and they were pretty boisterous, pretty vocal, and pretty much had to be. And even then, they still didn't get a lot of trades. But
Did the basketball technique last very long?
it lasted until it went electronic. Their advantage was they would be on the market, whatever the market was. If it's 1/2 bid at 2 even, I look out and I say, what do you guys do? What's here? It'll be 1/2 at 2 even. What do you want to do? I'll buy 2 even trade, and then it'll be, half on 1, 60 on 1, 70 on 1, and try to make 2 or 3 ticks, whatever you can get. And then another broker will see it, and he's bidding 70, everybody else is half. Hey, Reggie, sell you 1, type of thing, and they did that all day long. So it was a little different then. You'll see some other guys that are bigger, and they just kind of stand around, and you can't really tell what they're doing. The guy, Steve Presnewski, I don't think he's still down there, but he eventually got so large and so good that everybody leaned on him as opposed to what he's doing. So if he was there bidding, every little guy in front of him and all around him, they're all of a sudden, they're like, oh, 10 bid, 10 bid if he's standing here, even bid. So eventually what it came down to is he would just go the opposite way. So if he wanted to sell them, he would put an order with a broker behind him, and he'd start bidding them up, even bid, half bid, even bid, until he'd hear he's filled, and he'd be like, okay, put his hands down. So little tricks like that, and it worked for him.
Before, just at the time when it was kind of like pit and electronic, were there still some things that guys in the pit could do in terms of that they just can't get away with anymore, or is it just more?
Pretty much it was, I don't know if they still call it on the squawk box, but they'll race the paper. So if you see a broker come in, he may look a little nervous, he may get in and start to offer, 100 at 2 even. The locals all around him, they're going to sell everything in front of them if they can get to it first. And then they're going to turn around and bid to them. They just make a quick scalp. So they call it racing the paper. So you'll see Merrill Lynch, they're 2 of the bigger guys up there, and very vocal to be at 2 even, 1/2 at 180, and somebody will jump in front and take a trade from another guy across the pit, and that's going to start a fight and be like, you son of a, that was my trade, you should have had it. And then as soon as they get basically you'll see how far the broker's going to go down. It might be a limit order to sell them down to 1 even, so they'll chase them all the way down and sell the O evens. Oh, he stopped offering at 1 even? Okay, buy him. So they'll stop right there.
It's amazing that it works at all anymore with all the conniving tricks.
Yeah, there's.
That's why it works.
Who keeps the accountability of these trades, like the locals or
The accountability of the prices that are traded,
Right,
or
you know,
just
they
the
say,
fact that
"Well,
you
I
made a
bought
trade?
this," and
Oh, you mean
then-
the bills?
Yeah. That they actually made the trade.
Well, you have two ways to check it. First, you're going to write it down on a card immediately, and I'm going to check with you that we just made that trade and do a little check. Yeah, it's good. Then I'm going to tear off the call to dupe, hand it to my clerk. And he's going to take that and he's going to go find your clerk, and he's going to say, checking, Shag sold you 20 at 2 even. Be like, yeah, it's good. Circle it. He comes back. Everything's fine. So that's also why you'll see paper all over the floor. All the trading cards, they have two sides. So if you sell them, basically you cross out the buy side so nobody can use that. You tear off the dupe, throw it on the floor.
It's either that or the paper is like somebody, like one of your orders that's been misplaced and it's sitting there on the floor.
So let's see. Back in the 90s, there were
I'm sorry, if you're doing hundreds of trades a day, how do you keep track? Do you keep a track in your head or on paper if you're up or down or where you are in a day?
they have a clerk that keeps track for them, usually. Or usually they keep a little card, and they usually just keep track of
Go
ticks.
back and ask him, where am I? Or
Basically, yeah, where am I? They'll be like, you're down 120 ticks, or however they calculate it. But for a lot of them, it's not that tough. But you will see many clerks. The same guy who's doing your out trades can also keep track of your P&L for you, because he's tracking every trade that's good, that's bad, and he's reporting back to you. But when the E-minis first came out, you'll see a bunch of terminals that are up above that are, it looks like where the phone desks are. And those guys are sitting there watching the pit. And that was a huge edge right when it first started. They could sit up there, watch the pit. They can see what all the brokers are doing. And though not technically legal, they can see what the phone clerks are doing. They can see like a flurry of activity over here. They can see all this. And then they see all of a sudden a bunch of sell orders start to go in over by Goldman. They can just sit there and nail the minis and just start selling the minis because they know this guy, something's going on over here. And so they'll sit there and do that. That went on for, I don't know, probably 3-4 years. And actually when I left the floor, that's what I did is I set up shop with a bunch of guys like this that were electronic traders. And they sat up there and made very good money for a few years. And then when that kind of died down and really wasn't, the play wasn't there, the market started to dry up a little bit. They went upstairs to try to trade and using charts and things that you guys have been looking at. And I don't think a single one of them is still around today. But these guys, they made a ton of money trading in the pits. Very good pit traders. Went off the floor, gave it all back, and then some. And you'll still see guys on the floor that have been there for years, and I can't imagine they're doing extremely well. They still might be making money, but nothing like it was back in the heyday in the 90s when we were moving around 2 points at a time, when it wasn't bidding like quarter bid, half bid. It was 1 even bid at 2 even, 2 even bid, 3 even bid, 4 even bid, at 6 even.
give me the figure of how much they made.
In a given day, it was not uncommon to walk away with $300,000-$400,000, $1 million. When I also traded up in the NASDAQ pit when that first started, and as that got really busy, the guy Mark Variano standing right next to me, he retired. He was smart. Standing right next to me, he would trade off of cash and the S&Ps, and he would trade the NASDAQ. So he's looking around, not much is going on. He's watching the cash starts to tick up, tick up, tick up. There were some huge offers by brokers in the NASDAQ pit. He looks over at him. He's like, buy 100, buy 100, buy 100. 2 seconds later, boom, the market jumped about 200 points. But he made over $1 million in literally 30 seconds. And he was just like, sold, 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 sold. Took off his coat. He's like, I'll see you guys. And yeah, he retired shortly after that. He didn't give it back. Super nice guy, smart, obviously, smarter than most of them. A lot of the guys would do the same thing, then they tried to do it again, they get caught on the wrong side, and then they would fight it. Things you guys probably seen before where they just keep buying in, buying in, buying in. Next thing you know, they're down $1 million. And
Now, did you find, like, one of the things, I know a couple of questions that we had even when Ben was here, and some questions that we've had while we've been here is, you know, there's a perception that, you know, the locals are so much either smarter or always are making money and things like that. I mean, in your experience, I mean, how long would the average local last before they got blown out, or what was the ratio of guys that could actually?
In the late 90s, it was pretty simple to make money in the pit. The key was getting in and getting people to trade with you and being able to trade with the paper, being the brokers. Whenever locals are trading with each other, it's going to get ugly because one of you is going home a loser. So it's very difficult, and that goes on more today where you see it's a local market. If it's a local market, just step back, stay away because nothing's going on. You're going to get a lot of choppy movement back and forth while they're playing around like where the paper offer and bid is. They're just going to bounce around back and forth. When that happens, it gets really ugly. Locals start to fight. Emotions get involved.
That's probably the good thing about electronic trading, because in reality, in electronic trading, if you're making money, you're taking out of somebody else's account. When you're on the floor, you can see that you just took money from him, or something like that. So it's probably a lot more personal.
Yeah, you know it. And usually on the floor too, you as a broker, you kind of keep track of all the guys you trade with, so you know their position. Just makes it a lot easier for trading. If I know that you're short and I need to buy them, I'm not going to come back to you and make you even shorter. I'm going to go to the guy over here who's long. I'm going to buy him from this guy. And with locals, you'll see a lot too. They'll be like, "Do you want them?" And be like, 50 at 2 even. And like, buy them. How many? Do you want all 50? I'll take them. Type of thing. Or they'll say, yeah, I need them. So locals will trade that way and no harm done. If you pick somebody off, picking them off means you'll try to push the markets around. You'll see guys who just stand there like this. It's even bid. It's not going down. And they just try to stand there and hold the market up. And they don't actually have to trade. They can just stand there. Like if you're trying to sell them to me and I don't look at you and I don't see you and I don't hear you, I don't have to make the trade. There was no trade. So you'll see it's even bid, and I got my head down looking straight like this. It's even bid, and of course.
That could have some interesting outcomes.
Yeah, it only lasts so long.
Could be another one of these.
But some of the bigger guys in the pit would really bully it around like that, and not a whole lot you can do. You get a huge guy, some of the bigger guys in the pit standing there holding the market up, even bid. This is before the computers were around. I've got orders to sell. He won't buy them from me. My clients are wondering, why aren't we getting anything off? The board's frozen at even bid because if it goes a tick down, they're going to get their heads ripped off by this, by this huge trader. So it's like, all right, wait for him to calm down. Are you done? You're done. Can we trade now? Okay, at 8. So.
Have you seen, or I guess in talking to guys that were, used to be on the floor, I mean, are a lot of them, if they're still around, are they trying to make the transition to electronic trading? And how's that going for them? Or are they really just trying to stick it in the pit?
Just about everybody that left the floor. There's a lot of little shops popping up. We call them prop shops, like Revco backs guys. I ran a couple for a few years where we would back the traders, bring them upstairs, show them how to use computers, how to use the software. We would train them on all different types of things like that, and then they would trade the money and sit there all day. It's it's very tedious and time consuming, and you really have to have the guts and the discipline to sit there and trade. So they would sit there all day, and we'd fill up a room like this. And they would trade all day, and basically you just had to risk manage and kind of find out who has it and who doesn't. And what it turned out to be is the guys who were good on the floor usually were not very good upstairs. So it was the little guys that were on the floor, they couldn't get a trade. You couldn't get a one lot if you were on the floor in the S&P pit. You wanted to trade a one lot. Say the market was 2 even bid at a half. You could bid 2 half. Nobody will sell you a one lot. You could bid 3 even. You could be giving away money, and finally somebody will just say, fine, sell you one at 3 even, or whatever the price is, just to get them to go away. But they wouldn't trade a one lot. Like say you're a broker and you've got 50 cars to sell, and you're over here bidding 10 on 1, and you're 20 on 2, you're 30 on 1, and you're the lower even on 200. It's like, oh, sold. Evens trade. You got nothing, you got nothing, you got nothing. Even though you were a better bid, you're really not going to risk it for your client. Like if I start selling you guys ones and this guy sees me and he's size, he's like, I know he's got size. Sold, sold, sold. Now I'm going chasing the market down. They're racing the paper. So I'm just going to skip over you guys, give it to that person, and then they can take you out if they want to. So.
Is that one question?
Usually it's going to take a while. When you first go down there, you're not going to hear anything. But right now, if I walk down there, I can, with my back to the pit, I can tell you it's 20 bid at 30. J-Pro's bidding, this guy's offering. It's 20 bid at 30 is the market. You're going to hear half. You're going to see even. People calling out all these different prices, but you're like, no, the market's 20 bid at 30, the real market. It takes a while just to get in the flow of it. And one of the scariest things is when you first start, like for me, it was getting up on the top step. I've got an order, and I'm seeing all these markets go on. I see over in that far corner over there, looks like they're trading 2 evens. These guys look like they're trading 30s, 40s, halves, 60s, and I'm 30 bid, and I see them trading even, so I'm going to start bidding 30s. And everybody in front of me is just like, shut up, you moron, it's half bid, Jesus, get your head out of here. It's like, but they're trading evens over there. It's like, what? That's the upper even. Oh, okay. So you sit back down and wait, and finally you get the hang of it, you hear what's going on. And you can't be intimidated. You can't be shy with the voice. That's how I got the bad voice. You just have to stand there and yell and protect. Basically, if you guys were calling in orders, we've got to protect your bids and offers. And the reason I have a sore voice is because how fast we were moving. It just so happened that everybody who wanted to be 10 bid or 1 at 40 or 60 bid was going through us, and we were trading in halves. So it was even bid at a half. 200 traded even, 400 traded a half. I'm 10 on 1 and 1 at 40. So. They're not going to hold the market up. Yeah. So anybody who traded back then and you wonder why, your 40 offers or 10 bids didn't get filled, it's pretty much because they were trading size all around you and nobody was going to touch your small orders. And that's really facilitated the E-mini too, because now it allows everybody who's trading small, even if you're trading a 5-lot, but all the 1-lot traders, now you have a reliable place to go, easy access, you get filled, you can see where the true market is, you don't have to deal with stops getting set off the market. They will do stop hunting still with the computer, but not nearly as bad as it was in the pits. If there was nobody bidding in the pits, if there was no paper, locals really wouldn't trade with each other, so they would say, 1 at even, 1 at 90, 1 at 80, 1 at 70, 1 at 60, 1 at a half, 1 at 30, 20 trade. A broker standing here going, come on. Don't do that to me. Because he's got 20 stops, 10 stops. So all of a sudden he knows it really shouldn't be trading there, but as soon as the print goes on the board, he's got to fill the orders, and now, out comes his deck, sold, 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 and just run the stops.
More cheating.
Yeah.
Would everybody try to be even at the end of the day and have no positions, or?
Most locals will go home flat. And another thing they do, they don't do it electronically, is they have post-trading. And post-trading is right after settlement happens. Then you can trade to get flat within a few ticks of the close. So usually that's where locals, some firms will still be trying to get out of their orders and things, and other locals will match up with other locals. If you're long 10, I'm short 2, we can make a trade in the post that doesn't get recorded. It's not open outcry really anymore. It's just like match it up so everybody's safe and goes home flat.
What like now today, like I know a lot of the larger firms will go into the into the pit to if they've got size and they're hedging and things like that to get orders done. And I guess this is kind of a guesstimate, but in terms of like the larger houses, what percentage of their trading is done in the big contract versus the minis today?
I haven't seen it, but from what I know, talking to other day traders, they're playing games now. The firms are playing games in the pit, whereas they'll send a large order into the pit and say, just start buying them up to like buy 200 and do it aggressively. So they'll go in there, buy 5, 10, even bid, half bid. Meanwhile, in the back office, they're sitting with the finger on the sell button, selling the minis. So they're kind of like propping it up with a lot of, very boisterous, like something's going on, they're getting long, Golden's buying, Merrill's buying. Yeah, they're selling. Click, 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 click. So you're going to see this creates a lot of choppiness in the S&Ps especially.
And this goes back to what Ben was talking about too. We're talking about tick fades and stuff like that. And Ben was talking about when you hear him getting really excited and stuff like that, that's not the time. That's not the time to buy for a couple of reasons. One, it may be the end of the move. But then if there's something like this that Pat's just talking about, somebody just coming in trying to bid up the market like that, you don't want to get sucked into it. So loud is more of a signal to kind of fade and things like that too. And it's just important. It's just important to know what's going on or the possibility of what could be going on. Remember, you always want to remember who's taking the other side of your trade.
And the floor is all about being deceptive too. So, you had a question?
Like Refco, when they train their traders, do they just give them one strategy, or do they give them an intensive 17-week course?
There's nothing intensive about it. Basically, as an example, they would give you $25,000, ask you how you trade. They want you to trade actively. The less time you're in the market, the less risk you have. They want you in, they want you out. They want you to trade momentum, get in, get out as fast as you can and as many times as you can, because they're also making the clearing on it, even though the rates are pennies. But they'll match up with somebody who is making money, and they'll be like your mentor. But pretty much it's just you going in, they give you money, you either make it or you don't. But
it's like, don't let the door hit you on the ass on the way in, kind of thing.
Usually the way it works too is I've got a couple of friends there, and one good trader makes up for about 40 guys that lose $25,000. So they're like, okay, we found one out of 41 people. We're doing okay. So.
That's the opposite of the way that you guys are teaching us to trade. Don't be trading all day long. Just wait for the good setups and just hang out.
Yeah, you got to remember too. I mean, the advantage there is a distinct advantage to being on the floor like that. Your rate, I mean, you have a first mover's advantage if you're doing like momentum trading and things like that, and then your cost of trading is very, very low. The advantage of what happens then is when these guys get off the floor, and I was just talking to one of these guys a few days ago. He was doing 150 trades a day in the pit, and now he's cut back to 100 trades a day electronically, and he's getting his head handed to him, and he's just like, I don't know what to do. And then so I was just kind of telling him a little bit about, look, it's really waiting for about 10 good setups. That's the difference between trading online versus doing that. I mean, it cuts out a lot of the noise. You're patient. You're sitting there with limit orders. You're not chasing noise and things like that too. And so that's the biggest difference between I think, in my experience, off the floor trading and floor trading is off the floor trading. You don't have the advantage of being there in the pit and doing momentum and stuff like that. So why not trade less, wait for more higher probability setups? And it's kind of like, do you want to have fun or do you want to make money? I mean, it's fun sometimes to trade 100 different times a day, but again, would you rather make money?
And the guys doing it too, they're a huge risk. Like the guy at Gelber was 3,000 up in the mini S&Ps. Like I don't know if you guys have seen like the domes and the TT things. They would shrink it and they wouldn't even look at bid or ask size. They wouldn't look at price. They didn't care about anything. They just saw red and blue where the bid and offer were, and they would just smack it, put their offer up here, jam it up into their offer, get people to go on their side, create fake momentum when there was nothing going on. 3,000 contracts. Yeah, he's not doing as well as he used to be, but yeah, they're still. Yeah, and I've my one friend in particular, he knows the guy. He knows when it's happening, and he'll go in and he'll take an extra 2 ticks on his tails. Be like, yeah, I can see it happening. I can see the trades going through. I know his style. I can see the book. I know what he's doing.
So when you see like on the dome, you've got the bid offer and you see the depth and stuff like that. How much of that? Well, obviously you never know. Like how much of it real? How much of it fake? How many games are going on in there?
Yeah, it's usually if you sit there and watch it all day, you'll get a feel for who the players are, the size, and when it's real, when they want them and when they don't. When it gets close and it touches, are they still there? Usually that's a good indication that that person is trying to force the market. It's just the opposite of what you would think. They're trying to force it down. They're like, yeah, I'm not afraid of you. I'm not afraid of you. It's when it disappears, it's like, okay, what are they doing? They're putting in 50. They're putting in 20. They're putting in 20. They're putting in 50. They don't want to scare it down, so they try to just pepper it slightly. So when they're showing their size and they're showing strength, it's usually an indication that it's completely opposite. But then you'll get Refco put in orders, like 6,000 lot orders for clients and things like that, for huge institutions and things. They'll just put them out there. They want the price, and they'll just put it there.
Refco, I used to deal with Refco, and they had a margin of like $1,000, and then all of a sudden it went to like $5,000. You know why that would be? For
A margin for day trading?
Minis?
day trading.
Really? That's the first I'd heard of that. I
They
don't know.
went out of sight.
For yourself too, right?
No, I don't trade anymore.
Pat right now is one of the main brokers that we use is Mirrors Futures, and Pat is with Mirrors Futures. And what we kind of rely on them on is you've got I think some of you guys in here are working with them as well. And it's kind of like you've got Pat knows he's been in the pit. He knows all the systems, and he started off bringing electronics into the pit, so that's why everybody there hates him in a loving way.
Yeah. Well, now they joke about it.
Right. Now it's funny. And so his kind of specialty now is kind of taking that knowledge now and just kind of helping to work it into the online, the online brokerage and things like that. So it's literally, because you guys are pretty much in the process of continuing to build up the brokerage part of it, and that only takes about 19 or 20 hours of your day.
Right. More specifically, what I do is focus on black box trading is becoming more popular, and working with firms to automate options trading so that you can actually trade options electronically if you want to. So we're working with people like that will make markets, fair markets in the options, as opposed to a dollar bid at $50 for an option that's worth $3. So there's arbitrage and things like that. There's ways to do it. So that's what I'm working on, people that are writing systems that automatically hedge an option versus a future, or just a regular trading system if they want that to be automated. Guys will call, they have an idea, they're systematic, they're just, they would rather it was just done automatically, and then they can tweak their system. I'll work with them, find them the best tools that they need, get their system automated, which platforms to use, that type of thing.
Is that like some of the main trends that you see right now? Is it kind of trying to go more and more towards automation, or is it kind of both, or what are the things that you see there?
Right now, the big black box traders are really picking up. By black box, I mean it's a computer algorithm that's doing all the trading. There's no GUI interface, there's no charts, there's no anything. It's mostly done in New York. There's a little bit here in Chicago. I've got about 8 groups that are in our building that are mostly black box. That means they write an algorithm that says when this happens and this happens and this happens, make this trade. It's usually for interest rate products. The S&Ps and the Dow, they're a little rough to automate any kind of trading system for, as far as this goes. But trading interest rates and those types of things, these guys can really get creative, and they can hedge it in multiple places, and they can go into the currencies. Currencies are really picking up.
And is it like currencies like on the CME or in Forex or both?
On the CME, Euro FX has been around for a while, but that's really picking up.
Okay.
Japanese yen, Swiss franc, a couple others people are starting to go into, or the volume's starting to get there, and the volatility is starting to pick up to make it a decent trade.
Okay.
What was the question?
It was the trade du jour when China revalues their currency. Really, I mean, everybody thinks that when that happens, that their currency is going to go up like 30%. Relative to where it is now against the dollar. There's a couple of ways to take advantage of it. But let me back up. To me, when everybody thinks something's going to happen, then, okay.
Yeah.
But, I mean, there's 2 ways to take advantage of it with the currencies. I mean, you can do it one way, or you can go to something like everbank.com where you can actually open up, go online. You can open up accounts in any currency you want. You can open up accounts in euros or, the Chinese currencies or whatever. And then once the currency is changed like that, then you actually benefit from any appreciation in that against the dollar or depreciation, depending on how you're positioned on it. But what are you gonna do?
Short answer would be buy low and sell high.
Yeah, exactly. And that's the training program that most of the guys try to go through. Or sell high and buy low.
Was that everbank.com? I've heard you refer to it before.
Yeah, it's a great online service because I mean you can just take, here if you've got a CD and you're trying to get like 2% or something like that, and in Australia they're paying 4, and in Mexico they're paying 8, you can just open up the account there, convert it into whatever currency you want, go back and forth, and do it that way. It's kind of a cool little feature. All right. Any other question or any other things off the top of your head, or any other questions for Pat?
Yeah, don't you handle accounts for people in the room or something? I mean, if people wanted to open up an account with you at Myers Futures, would they just call you?
Oh, sure. Yeah, we handle just plain normal traders as well.
I call them all the time. It's great. Help on the phone. I get
Yeah.
When Ninja crashes, I call Pat.
Oh, Ninja crashes?
Ninja
What?
crashes occasionally, right?
What?
You didn't know it was me, did you?
I recognize the voice now.
Oh, Pat is in New York.
Yeah.
That was a loaded question. I do business with these guys, and out of all the brokers I've used over the last 4 or 5 years, these guys are there. You can call them, get them at 7 o'clock in the morning Miami time, and this is Chicago. You can get them at night, get them anytime, and they really, 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 really work with you. I mean, it's the only reason I do business with them. It's absolutely
yeah,
incredible.
and that's the thing that I like, and the reason we've kind of developed a relationship with these guys is that gone from broker to broker, and it's like you call up, you got to explain who you are, what your account number is. Sometimes you get voicemail, and finally, like these guys, it's like a smaller firm, they're hungry, but at the same time, they're clearing through the top 2 FCMs that are out there. They've got all of the top performing platforms that you can get, so you have access to pretty much the most advanced technology that's out there. But you got a smaller firm, they get to know you. You pick up, they know who you are by your voice, and
Every one of them's good. Pat and all his crew are just fantastic.
So how much do I owe you for that? Your car's out front.
So do y'all offer all the futures?
Yeah.
Right?
Yeah.
Currencies
Currencies, futures, pit traded products, options, any exchange.
Do you have kind of a menu of systems that you can offer prospective clients that are successful?
We have a few. We basically work with a few at a time. And if they're working, great. If they're not, they're not. One thing I do is when I have a guy who's doing well with the system, I'll just ask him and say, do you want me to bring in some more people? Are you interested in expanding? They'll say yes or no, and that's the end of it. If they don't want they don't want their name out there, then I don't talk about
If
it.
he's interested in expanding, what does he get?
Usually he's set up as a CTA, so depends on the split, and account size, that type of thing. But
Do the black box systems work?
black box systems? Oh yeah.
Yeah?
It gets a little more complex. It's not just moving averages and things like this. They're basically taking interest rates over here versus over here, kind of the rubber band effect with the bonds, putting all those things together, trading on multiple exchanges, doing the options versus the futures, different spreads, legging into spreads. Not all of them work, but yeah.
You have business cards?
I didn't. I was just here to talk about the floor today.
I know their phone number. I mean, okay. Mark.
There's 2 or 3 guys right now at Revco that trade that by hand. Basically, what they do is they watch the fast cash, set up with Excel sheets, put in the bid, the last, the ask of all the stocks, and do the calculations. And you have the fair value of where the future should be trading based on the cash. And they trade that, basically just watch it all day long, and they're trying to make a point, 50 cents, 2 points, but very high probability because the two have to stay in line. So if you see one move and the other hasn't yet, they'll just make that trade. They've been doing it for years. They first started at the prop shop I was with in '99. The trade disappeared for a while, but it seems like it's back again, and they're doing fairly well with it. But again, it's a high volume thing, and it's quick. You're looking for 50 cents or a point because the premium, when there's a difference, it doesn't necessarily give you a direction which way it's going. You just know that they're out of line. And unless you're doing a baskets of stocks versus the futures, it's a bigger gamble. But I don't know, is that the premium you guys trade?
Yeah, well, yeah, it'll be set up as like just a chart of the premium. Like usually it's like look at the ES. It seems like it's a little bit faster than the big contract, and then look at the values for the day. So if it gets up to 6, and that generates a buy program. If it gets down to like 2.52, if it generates a sell program, that kind of a thing.
Oh, okay.
Just to kind of see how that's where the levels
To watch
are
the
for day.
institutions, okay.
How much does your system come to if some person wanted to buy and want to take them on?
I think, as I understand, I mean, you guys don't actually. There's not systems that are for sale.
It's you as a trader saying, I'm a systematic trader. I'd like to get it automated so I can do more markets or do whatever this is. And then I work with you. You tell me what it is you're doing, and I find the best platforms and the best way to put it together and make it work for you.
So if you have a setup that you like, and now you just want to go play golf or something like that, you could tell Pat, these are my criteria. Can you figure this out, please? Can you help me? And then they'll work.
And a lot of guys do. They'll go on vacation. They'll say, can you run our system while I'm gone for 2 months? Here it is. It's in TradeStation or whatever language it is, and we just turn it on and keep an eye on it for them.
How many clients do you have?
You're up to 3 now?
Oh, 4 with Bob. A couple hundred. Yeah, several hundred, but
How far away are you from capacity, you think?
nowhere near. A lot of what I do is automation too, so I know what everybody's position is, who they are, and I can create quick and easy reports. So if you talk to Kurt, he can quickly pull you up and see what your position is, where you are, who needs what, trading patterns, so I can keep an eye and know this is outside of their realm, or they usually don't have a position this time of day, this guy doesn't trade this product, that type of thing.
Kurt's one of their desk traders, and just like what I'll do, especially like if I'm traveling and stuff like that. I mean, he'll call, touch base. You want your stop moved here, like for swing trades and stuff like that. So it's kind of nice. You just have somebody who's just kind of handling that for you, and it's great for me. Okay.
So Pat, what we're saying here is that say NinjaTrader goes down, you can't trade electronically, then you're just a phone call away, and you put the trade in, and I pay same commission.
Right. And we have alternate means. There's the Globex actual front end itself. If Globex goes down, there's not a whole lot you can do. It happens very rarely. But if NinjaTrader goes down, if JTrader goes down, if some platform goes down, I've got multiple platforms to get out on. I've got an order desk where I can call directly into Globex and tell them to cancel orders, put in orders, make the trades.
When you're there, somebody's there the 24 hours.
Right.
So Globex is running.
Right. Like EuroFX, when that went down, that's actually a PITS rated product as well. So that wasn't an issue. We could just call the floor and get people out of those positions. It's only the mini products that you're really at the mercy of Globex if Globex does go down.
What about PDA capability?
Wouldn't recommend it.
Yeah.
I mean, if you want to keep an eye on the markets, that's great. You're already on a PDA. Why not just call us and we'll make sure the orders are working and in, and we'll give you a call when you're filled. There's too much error, too many problems can happen with them. It works. I mean, I've tried it. You can use a JTrader type of thing on a PDA, but you're looking at 56K modem speeds. The prices you're looking at are probably late. If you get an order that's stuck out there somewhere, is it going to go? Is it not going to go?
I was not actually talking
So.
about making orders, but maybe seeing where stops are good, or just checking.
Oh, checking positions and things like that. We have an online portal where you can log into. It's about five minutes delayed, but it'll show any positions and anything like that.
Do you know anything about Globex and where it actually is, or like what is it, like server room?
Where it's located, it's all kinds of servers. Yeah, actually, I work in a lot of detail with them.
Chicago, or is it spread all?
They have it's in Chicago. There's one in Lombard. They have backup locations. Basically, it's just a bunch of computers put together.
That thing can never go down.
Does once in a while.
It does. I mean, it has
went
its
down-
problems.
It was a couple of months ago, or maybe even. But what happens, and we're talking about this, is that being familiar with, like, say, if you're an E-mini S&P trader, just be familiar with the Dows, because if the Globex goes down, you're pretty much hosed in terms of getting out of that. You can hedge it with, if you're long 5, you can go short 5 of the mini Dow and hedge it, because it's very, the chances of both of them going down at the exact same time are very rare. Or you can go into the pit, one pit contract for every 5, you can hedge that way. So there's ways to hedge it, but when Globex goes down, you're pretty much locked into that position. But there are opportunities to hedge it and protect yourself.
And it's not just Globex. It's not like one big computer. Like, each product has its own server farm, sets of different servers. Like EuroFX went down because they were doing updates and they made changes. So, but it was only the EuroFX. You could still trade the mini S&P. You could still trade these other products. It was just these servers that they had made changes to went down. I would be careful right about now because they're updating. They're adding Eurodollars. I don't know if anybody trades Eurodollars, but it's a pretty complex product. It's got 40 months out. It's got all kinds of options and packages and bundles and things, and they're just now throwing that on board. They upped their bandwidth to 20 megs, and it used to be on a T1 line was the most you could get. So they're really beefing this up and adding products and adding options. So I'm a little leery. I mean, I'm sure they're doing it right, and it's just, when somebody's making changes.
All upgrades always go real smooth.
Yeah.
When are they supposed to be live on that
It's live.
already?
Yeah, it's going. It's just there are always changes, and so they're basically playing around in there, and it makes me uncomfortable, but it's for the better.
Very good. Okay. Well, I think that's about it. The main thing I wanted Pat to come over here for is just kind of talk about his experiences in the pit and stuff like that. I think it's, again, really important for you guys to understand. Remember, who's taking the other side of your trade. It could be another electronic trader. It could be somebody in this room or somebody in the pit. And I think it's important to understand psychologically, where each of those profiles are. So thank you for a very good job of enlightening us on that, and thank you for stopping by. So what I want to do here is we've talked a lot about day trading setups, right? We've talked about, you've seen a lot of different methodologies. We haven't really talked about swing trading setups. So what I want to do is talk about a swing trading setup that I use. I use this for stocks, options, and then as well as single stock futures, okay? Now this is a setup that you can do, for those of you that are just day trading, you can do the setup intraday as well, okay? But I'm going to show you that. But I use it personally as swing trades. And again, this goes back to what I was talking about. I mean, for me, day trading is kind of bread and butter. It's cash flow. I'm using this to pay monthly bills and things like that. Swing trading is more wealth creation. And the whole idea of swing trading is that you're not going to be, every day that you're in the market swing trading doesn't mean you're going to be making money. The idea is to be positioned for the 1 or 2 or 3 times a month when the market does make a really big move. Okay, remember 75 to 80% of the time, the market is trading choppy to sideways. The market has a habit then of moving very, very quickly for a couple of days and then pausing again. As a day trader, you're going to miss the bulk of that very quick move. Okay? But why I like to be in the market on a swing trading basis is that I do know that those 1 or 2 times when the market does make a big move, I'm generally going to be positioned for it. Okay? And that's what this trade is about. So the first thing I want to talk about is single stock futures. How many people here have ever traded a single stock futures contract? Couple people. Okay. I just want to talk a little bit about how they work, just so you guys understand. Then I'm going to talk a little. How many people here have traded options before, like on stocks? Okay, pretty much everyone. I'm going to talk a little bit about. I'm not going to talk about how options work. Okay, I'm just going to assume that you guys know how they work, and it sounds like you do. But I'll talk about how I buy and sell them. And then third, then after that, we're just going to go into the setups. Okay, because all the setups are the same, but I use these three instruments on the same setup. So single stock futures, pretty much they trade on one exchange, which is One Chicago. They used to trade on another exchange called NQLX. That went out of business. One Chicago acquired their volume, and they're the main. I mean, that was like a no-brainer. They're backed by the CME, the CBOT, and the CBOE, and they were the ones that were going to survive. These other guys were just going to give it a shot, and that didn't work out. These trade every month, just like options. The reason I like single stock futures is that you can participate in the movement of a stock using single stock futures without any of the premium that comes into play using options. Okay, when I'm buying options, I'm going slightly in the money, so I'm looking for options that are usually about 70% intrinsic value, 30% premium, which is about the same ratio as what a single stock futures contract is. So it's a way to take advantage of that without the premium games. For those of you that traded options, that should make sense. If you've never traded options, that was probably all, which is okay. So they trade every month. This is how you enter in a symbol for a single stock future in TradeStation. So you just put in the underlying stock symbol. 1C is One Chicago, G is the month, and then 04 is the year. Obviously now it would be 05. The nice thing about this is if you're a smaller trader, and you really like stocks, there's no $25,000 rule for day trading. You can have a $5,000 account and day trade, Amazon and things like that. No margin interest. And this is really not as important as it used to be. I mean, they're starting to get away with this on stocks too, where some of the larger stocks can move, you can short on downticks, but that was something when they first came out that was good. The main thing with this, single stock futures, it's pretty much 20% margin, okay? If you're going to buy 100 shares of IBM at $100 in cash, you got to put up $10,000. Okay, if you're going to buy the equivalent in the single stock futures contract, you put up $2,000. Okay, you guys know what that means. The biggest question I get on single stock futures is what about the volume? Okay, single stock futures are a relatively new product. There's not a lot of volume coming into it. When they first started, there were times when I was trading Amazon, and literally I was the only volume of the day. Okay, I'd do 10 or 20 contracts, just trying them out, and I was like, I remember one time Amazon moved up $3 that day, and I was the only volume doing it. So it was kind of cool being the only person in the universe who made money on that. So that was kind of fun. Volume is starting to uptick a little bit, but the fact of the matter is it is at this point lower volume. So the question obviously is, John, why do I want to get involved in a low volume product? Well, the thing about single stock futures is the volume really isn't so dependent on how many contracts are being traded. The volume is really dependent on the underlying volume of the stock. So Microsoft trades 25 million shares a day, right? What happens is that the market makers who are sitting there making markets for the single stock futures, how they make money is somebody comes in an order with a single stock future, they're going to turn around and arbitrage that immediately out in the cash market. So they know that since Microsoft is trading 25 million shares, they can handle any size. So they just sit there most of the day because not many people are trading them, but then if you come in with an order of 100 lots or 500 lots, they're going to fill it because they can turn around and be perfectly hedged, make their penny per share, and they're done. Okay, so that's the reason why, even though there's low volume, you can go in and get orders filled. And it's the same thing like we were talking about the CBOT gold electronic contract. Right now it has much lower volume than the pit traded contract. But what happens is the same thing. There's guys that are just waiting to fill orders and then hedge it or arbitrage it out in the other one. So even though it's low volume, you'll get filled. Unlike low volume stocks, there's no, if you're trading a low volume stock and you try to get up there and go in there and do something with it, there's no one can go in there and hedge that. Or a low volume option, okay, same thing. So just wanted to clear that up.
Can you get out just as easily?
Yeah, actually I found that it's a little trickier on the bigger stocks. Like I trade CME, the stock. I pretty much day trade two stocks, Google and CME. And I've noticed on single stock futures, like on the CME, they'll kind of dance around your offer there sometimes because they're not sure, which way it's going to go. But I mean, I've never been hurt because of that. You know, I have limit orders, so I'm not. It doesn't matter. At some point, it's either going to fill it or it's not. I have not had any problems with it. When it first came out, there was one trade that I did in eBay. The cash opened at 90. I had an order. I forgot exactly how it happened, but my single stock futures fill was $1.50 above where the price opened, the cash price opened. And it was because of some algorithm that they had to figure that out. And since I was like the only one trading it, you know, they're like, oh God, somebody's trading this. And they sent me a check for $6,500 for the difference. I called them up and bitched and just said, look, this isn't right. And since then, it hasn't happened. So it's been kind of fun. I mean, and I like trading like new products like that just to see what they're trying to do with it.
Do they do some sort of a reasonably fixed premium for being a future?
Surprisingly, you would think that there might be a difference between the futures contract and cash, but it's like 5-10 cents.
Okay.
I mean, it's pretty close. So the main thing to remember about single stock futures is don't chart them. Okay, the volume is sporadic. The chart is going to be unreadable. So what I do with this, very simple. If I'm trying to find a setup, I've got the cash. This is eBay. I've got the cash chart, and then below it, I've got the cash bid ask, and then the single stock futures bid ask. Now this is off because I did this after the market closed, so obviously those aren't equivalent. But generally, you're going to see like the last on the single stock futures may be $1 less than what the cash is currently trading at. But all you got to do is look at the bid ask. Okay, the bid asks are both of the same. Make sense?
You can short these too, right?
Oh yeah, absolutely.
And what happens when they pay a dividend and you're short?
Same thing. And the other thing with single stock futures to remember, they are a deliverable. So if they're in your futures account past expiration, you're going to get the stock delivered to your account. Guaranteed that's not going to happen because the broker doesn't want that to happen, and they're going to call you every minute of every day during expiration to make sure you close it out at this point.
What about the tax advantage or disadvantage versus stock?
It's treated just like stocks. To me, which I don't like. I would prefer it was done as futures. It's treated just like stocks. Yeah.
And you got to get rid of it on the Thursday before expiration.
Yeah, no, what I'll do if there's something I want to be in for a couple of months, I just go a couple of months out and get that contract. Okay, so now options. I'm not going to go through how they work. I mean, you guys, I just want to show you just what I'm looking for. I mean, options, pretty much you guys know, is a leverage instrument. You're putting up a little bit of money to control a larger amount, yada, yada, yada. The main thing, my theory with options, and my background is in options trading, okay? I started off trading options. I mean, over the course of my trading career, God knows how many contracts I've traded, but it's been, I mean, tens and tens of thousands of contracts. I started off swing trading options. My favorite trade was when I was a senior in high school, October 1987. I remember 4 positions, long calls, like an IBM, Micron Technologies, Intel, and then as a hedge, I had OEX puts. And okay, I had those during the crash, lost everything on the calls, and the OEX puts made 18 times the money or something like that. And it was kind of my lesson in options hedging and things like that, and that was a lot of fun. But what I do with options, and my philosophy in options, is that I will not go out of the money at all. Okay, I'm not an options writer. I have written options before, it's just not my style. Okay, my research, my passion in the markets really is trying to guess direction better than anybody else. Trying to use different data points to figure out, is this market going to go higher? Is it going to go lower? I make that determination and then put my plays in accordingly, whether it's in the options market, stock market, or futures market. So what I want to do with that then is I want to benefit, if the market's going to move 10 points, I want to capture as much of that 10 points as possible, okay? I think the biggest mistake beginning options traders make is that they're going to go out of the money because those options are cheaper, and guess what? The move has to happen like considerably before those options really even start moving. Yes, you got a lot more leverage, and yes, if you catch a big move, you have the opportunity to make a lot of money, but I'm interested in capturing the move, okay? And I think that's a good way to put it. My goal is to, if eBay is at 100, I'm trying to buy eBay at 10 and participate in it. So I'm willing to buy an option that's $10 instead of trying to buy an out-of-the-money one that's $2, kind of a thing. All right, so here's an example if I'm going to set up an option trade. Okay, here's Google. Google's trading at $191.67. So based on what I've talked about, if I'm going to go in and I want to buy calls on Google, which strike prices am I going to use? Well, yeah, so I'm going to go down here to 180, 175. You can look at, if you go down to 190, all right, that's trading at $11.80. That's all premium.
That's a good thing, right?
It's the devil's work. You go down to the 185s, they're $14.60. So you got about $6 a premium. Now you look at these and it's like, wow, these are really expensive. $21.20 for an option. Well, look at this, 75. You're getting a good chunk of this. You're actually buying almost a $200 stock for about $20, give or take. So what I'm interested here is getting an option that at a minimum, if the stock moves $1, I want to be making at least 70 cents in the option. Okay, and you guys understand like about deltas and stuff like that. Okay, so delta of like 70 or better.
Blew up here.
Yeah. For puts, the same thing. We're here at $191, so I'm going out of the money, looking at the 200s, the 210s, and the 220s. Those are the ones that I want to be looking at. Back in 98, 99, 2000, when the premiums just exploded and they were very expensive. I remember when Qualcomm went from $250 to like $800. The calls that we were buying weren't the $250 calls at that point were going at $50. Okay, all premium. The $200 calls were going with a $20 premium. I mean, we're buying the 160 and the 170 calls. It's just we're paying almost $100 for an options contract, but it's cheaper than buying the stock at $250. That kind of a thing. So when Qualcomm went up a couple hundred points, so did the options, and that's the kind of thing that I'm looking for. Now Google, because it's such a volatile stock, the premium on it is ridiculous. IBM is a little bit more normal these days. Here's a stock at $91.20. The 90 calls are actually pretty reasonable in terms of the amount of premium that's in there. But even better is the 85 calls. There's only 20 cents of that is premium. The rest of it's all intrinsic value. Okay?
Is anything scary when as far as open interest?
Not really. I mean, most of the time, if you got an open interest of like right here, like 81, I'm probably not going to mess with that. I want to see like open interest. To me, if it's an open interest over like 1,000 contracts, it's good to go. I usually haven't seen any problem getting in and out, unless you're going to do a really big order. If I'm doing a really big order, like sometimes I've done 1,000 contract orders, I'm going to be doing it like in the queues. Queues, are trading 30, 40, 50,000 contracts a day, so you can get away with that kind of stuff. But you try to do 1,000 contract order on something that's got an open interest of 261, and that's not a good thing.
How far out do you go, John?
I'll talk about that. That's a good. I've got. Well, I'll just. What I like to do is the swing play that I'm going to talk about generally lasts about anywhere from a few days to a few weeks. Okay, so if we're outside 2 weeks of expiration, I'll go ahead with the front month. If expiration is 2 weeks away or less, I'm going to go out to the next month. So pretty much the front month, unless we're within 2 weeks, then I'll go to the next one. Okay. All right, you guys understand how options work. Okay, so this is how this trade works. All right, first what I'm doing is I'm looking at weekly charts. Okay, if the weekly chart is pointing higher, okay, and by pointing higher I mean looking at the 8-period moving average and the 21-period moving average. If on the weekly chart the 8-period moving average is in front and the 21-period moving average is below it, okay, that is a weekly chart that's pointing higher. So then what I'm going to do is I'm going to look on daily charts that are pulling down, that are selling off, and waiting for them to turn higher on the daily chart. So now you've got a daily chart moving in correlation with a weekly chart. Okay, and when then that happens, that's the setup I'm looking for. So I'll show you a couple of what I mean, and then we'll jump right into some plays. So here's Goldman Sachs on a weekly chart. Okay, right here, the 8-period and the 21 EMA are pointing lower. So then, obviously we've got a chart that's pointing down for all of 2002, and here we've got a chart that's pointing higher for all of 2003. So all I'm doing then is when I see a weekly chart like this of Goldman Sachs that's pointing higher, then on the daily chart, I'm just looking for times when the daily chart is, after being in a sell-off, is also turning higher in correlation with the weekly chart. Okay?
You want the daily chart to correspond to this chart.
Right. So what will happen is that as the weekly chart's pointing higher, you're going to have sell-offs in the daily chart that make it cross lower. So then you're just waiting for the next turn higher, so it matches that. Okay, trade and mechanics. These mechanics I really like because it's an exit-based strategy. Okay, again, it's always easy to get into a trade, right? This is an exit-based strategy that I found works really well in markets that we have had over the last couple of years. Okay, back in 98, 99, 2000, I did the same play, but I had an open target. I would just trail the stop. Now that we're in kind of a flatter and choppier market, I do this with a specific exit point in mind. So what I do is my goal is an 8% gain in the stock price with a 4% stop. So if it's a $100 stock, my target's going to be 108. My stop's going to be $96. Okay? Once I'm up 4% in the position, I'm then going to use the 21-period exponential moving average as my trailing stop. Okay? And then what I just do is at the end of the day, I update my stop. It's not a real-time stop. I just see where it is, and at the end of the day, I trail it. Okay? For options, I'm not going to try to mess with Black-Scholes or anything like that to determine the theoretical value of the option if the stock is at 108. All I do with this is that if the stock hits my target, then I get out of the option. Okay? If the stock hits my entry price, I buy the option at the market. Very simple. And like with Options Express, Thinkorswim, and those different ones, you can do that. You can say if IBM hits 108, buy the $100 July calls at the market. That's the best way to trade options. What I do with this then is if you just put it in an Excel spreadsheet, if you're going long, $88.45, you can just put the percentages in here. So your target's going to be $7.08 away, which is 95.53. The initial stop, 84.91. If you're up 4%, that level's 91.99, and then at that point, I'd use the 21 EMA. I used to do that with a calculator. With Excel, you just plug the numbers in there, and you've got them good to go. Okay? All right, so now let's look at some examples. So what's happening here on eBay, okay? Remember, first of all, I don't have the weekly chart here, but at this point, eBay, the weekly chart is moving higher. On the daily chart, we've had a sell-off, and now it's turning higher. And here, the 8-period EMA has crossed back up above the 21 EMA. Okay? Everybody get that part? As soon as it closes above, as soon as these cross, all right, when these cross and you have eBay closes above this cross, I'm going to buy the first pullback to the 8 EMA. Okay? So what happens here, we've got the cross. I mean, here eBay is above both of these lines, but we don't have the cross yet, so I'm waiting for both. So we've got the cross higher, prices are above. Once this happens, I'm going to place my first limit order to buy a pullback to the 8 EMA. So in this particular case, the very next day we come down to the 8 EMA, and I just get like a little bit in front of it, like 10 or 20 cents, get filled, and now I'm in the trade. My initial stop here is going to be $76.11, 4% stop, and my target is $85.62, 8% target. Once we're up 4% in the position, which is right here, we then start using the 21 EMA as a trailing stop. Boom, the target's hit, out, 8% gain. Okay? And then the same thing repeats here. Now, the cool thing is with this is to me, the setup it's a very clean setup. It works really well. The unfortunate thing about it is with stocks, you don't have that much leverage. Okay, you're making 8%. I mean, that's not bad, but as a trader, you try to look to maximize what you're doing. So, all right, here's the breakdown of doing the same play using the stock, single stock futures, and options. Okay, buy 1,000 shares of eBay at $79.28. That means you're putting up $79,280. Or you can buy 10 shares of eBay single stock future September contracts at the same price. You're putting up 20%, which is $15,856. Or you can buy 10 eBay September 75 calls at $6.10, and you're putting up $6,100. So here's 3 instances. You're doing the same play. You're controlling the same amount of stock at different price levels. Okay? Now, how I figure out that I want to buy the 75 calls is I only want to buy an option that has 30% less of premium. Okay, does that make sense? Everybody that trades options, that should make sense. I want at least 70% intrinsic value. In this particular case, we're right on the cusp there. We're just under 30%, so we're good to go. So $4.28 of this option is real value, and the $1.82 is premium.
How do you get the premium?
Premium, Yeah, 610. Okay, like 75. The price of the stock is $79.28. So 79. The option's selling at 610. So if you do 79 minus 75, it's $4.28. That's the real value. So anything over is premium. Yeah, time value. Okay, so how does this work out? So you sell 1,000 shares of eBay at $85.62. You make $6,340. That's 8% on your money. Or you sell the 10 eBay single stock futures contracts at $85.62. You gain the same amount, but that's 40%, a 40% return on the money that you put up. Or you get the 75 calls. You sell them at $12.20. You make the same, almost the same amount of money, but that's 100% return on the money invested. Okay, so same play, 3 different scenarios in the stock, single stock futures, and the options.
How do you control stops with the options today?
Good question. How do you control stops with the options? The best way is on the option, it's open parameters. If the stock comes down and hits the 4% stop, you get out. You have an order for your options contract. eBay trades at $74.11, which is your stop. An order for the option to sell at the market.
You can do that?
Oh, yeah.
In other words,
Options Express, Thinkorswim, whatever that, yeah. I use Options Express for options.
Is that a it's just an order entry?
Yeah.
Options Express?
Yeah, it's really the best way to trade options because that way you're out of all the games of, because it's very easy for an options to, to kind of fish for stops and things like that. And that way, the only way you're getting out is if and only if the stock actually trades at your stop.
And that's optionexpress.com?
Yes, options. It's Options Express without the E. So options and then the letter X, press.com.
So the only real advantage of doing the single stock future is the leverage. That's it.
Right. Then that's the stock by itself is, it's good for, if you're like an IRA account or something like that. You don't want to, either you can't do that or you don't want to use that much leverage. The advantage of the single stock futures and the options is just the additional leverage.
I was wondering, how did you come up with the target of 8% and stop before?
Oh, good question. Okay. How did I come up with the target of 8%? Now, I remember when I told you guys when I first started, I've been doing this play for, a decade at least. And when I first would do it, I would have an open target and just trail the stop. When the markets kind of started quieting, and actually I changed this, by looking at the VIX. If the VIX is high, then I won't have a target. If the VIX is low, then I'll use the target. Well, the VIX has been really low for a couple of years. The reason I do that is I have found, and this is really not back testing, this is my own trading experience, is that once a stock moves 8% in that direction, generally at that point it's out of gas and it's going to do an entire new pullback. So I've experimented with 12%, 6% and all this. A lot of times in 12%, it'd come all the way up, just miss it, and come down and get stopped out at the 21 EMA. So I found for me that this is a nice kind of a consistent way to make money in that regard. Those are parameters you could play around with too if you wanted to. And I found that a 4% stop gave it enough room to let it work out as well.
Okay. Can this strategy be used with futures contracts?
Yeah, I don't actually use the same strategy with futures contract on a swing basis, but I do a variation of it that I'll talk about more. But you can use this with futures intraday. And like if you're looking at a 220 two-tick chart, 233 tick chart, and you've got the 8 EMA and the 21 EMA. They cross. You can buy the first pullback to the 8. You can't use the 8% target because that's like 200 points on the S&Ps. But you can figure out kind of the same ratio. Maybe it's like a 2-point. I think the ratio is something like a 3-point target or a 4-point target and a 2-point stop. You can kind of play around with it. It's different on different time frames.
And do those options with the futures?
Yeah, hold on.
But I'm wondering, is there any reason, do you ever hold swing positions in the futures?
Oh, I do, but I don't use exact. Yeah, it's a different strategy. It's similar, but the 8%. This is really just purely stock, but I use a similar strategy for futures.
Tom, if I had to pick one of these strategies, why wouldn't I pick just buying the regular accounts?
That's a good question. If you just picked one of these, why not just do options? And the main reason for that is it depends on the account that you're trading. Like if you're doing like say a retirement account, sometimes you just can't trade options in it depending on how you have it set up. Sometimes it's like there's some accounts just don't want that much volatility. I mean, there's different reasons for that. For the most part, though, yeah, I mean, options are a good bet. You may find stocks, though, that don't trade options. Okay?
Well, if
or
a stock doesn't trade an option, you think it's going to trade a single stock future?
And that's okay. That's a good point. Now, there's only 110 or 120 stocks that trade single stock futures. For me personally, the way I find these stocks is I've just got a database of all the stocks that trade single stock futures. So it's like 120 charts, and I just flip through them every night. It doesn't take long. I'm looking for pullbacks. I'm looking for crossovers. You can expand that to other stocks, but then you eliminate stocks that have single stock futures, and you eliminate stocks that may trade options. And personally, I don't want to look at 500 stocks. I mean, 120 stocks is plenty. There's plenty of opportunity there. The exception is if you got some crazy stock of the day like Taser or Tizu or something like that. I'll go ahead and add those on there too. Yes.
Options in the futures. You're not looking at
There are options on the futures, but I don't do that play with this.
In this example, you got 100% gain on the equity options, 40% on the single stock future. It looked like the single stock future, you had to put up more money.
Then what?
If you go back to the previous slide, I think you had to put up like 16,000 or something.
Yeah. You had to put up 79,000 for stock, 15 something for the single stock futures, and then 6,100 for the options.
So yeah. So where's the advantage on the single stock future?
Or leveraging stocks.
Right, but you've still got the leverage within the equity option with less risk. You got.
It's your. I mean, that's what I'm saying. It's your choice.
And that's assuming you can find an option that
right.
doesn't have a big premium.
I mean, for me, it's like I try to keep my accounts kind of like it's like okay, I've got an account like as a CTA. Yeah, I can't do options in a futures account.
Are there tax benefits for single stock futures?
No. But like as a CTA, I can't do the option play in my CTA account, but I can do the single stock futures play. So it just depends like what your situation is.
Have you set this up as a strategy in TradeStation?
I have. The thing about it is that I found there's a couple. I mean, and me not being a programmer, I kind of played around with it on my own and found some things. What I do with it is just kind of do some filters and look at the charts myself and then set them up. I don't have it as a black box system or anything like that, but it could definitely be set up like that. For me, and I think it's just kind of like it's just one of those things that I like going through and doing it.
The problem with the strategy on TradeStation is though you got to be connected. If you lose your connection, the strategy goes away because it's on your machine locally.
Yeah.
So if you're using it to buy and sell, you're in trouble.
Well, that's why, I mean, for me, like if I'm running a strategy, I'm not doing it myself. I'm giving it to somebody like Miris to do because then they deal with that. Any other questions on this? Okay, let's go through some more examples. Okay, here's Qualcomm. Qualcomm, the weekly chart is higher. We have crossed down below, and now we've turned up. So here's the first day when the ADMA crosses back up above the 21. We close near the highs. The next day, I place a bid at the ADMA. Okay, we come down. I'm not filled. All right, so what happens? The ADMA has moved from up here to up here. So now my new bid is right here. The next day we come down, I get filled. I place my 8% target, 4% stop. In this particular case, Qualcomm hits the target in 2 trading days. Out of the trade. Now, since you can still continue to bid for the next pullback. In this case, once I'm filled, I place a bid the next day down here, doesn't get filled. Move it the next day here, doesn't get filled. Move it the next day here, doesn't get filled. Move it the next day here. And at this point, I've thought it's gone. There's no way I'm going to get filled. Then boom, we come down. Take out some stops here. I get filled. We're good to go. Now this first trade, out in 2 trading days. This next trade, place the 8% target and the 4% stop. We're kind of grinding higher. We get up 4%. So now we use the 21 EMA as a trailing stop, and it's 3, 6, 9, 10 trading days later that the target's hit. Okay, and that's a good example. I mean, you're going to have some trades that go like this. This is a little more common of what's going to happen.
Any reason you don't sell half when you hit 4%?
That's a good question, and you certainly could. I don't, but you certainly could.
John, it's also possible that if you were to lose the 4% right away, that your option wouldn't even decline by 4%.
Yeah, I mean, the cool thing, about the options too. Yeah, if the stock does go down 4%, the option, I think you're losing you usually go down about 20% or something like that, give or take, depending on what the option is.
I thought it went on zones.
Yep. Okay.
For those, because if it goes 4% the first day after you buy it, chances are it's still in the premium.
So here's another example. 1,000 shares of Qualcomm, $37.51. It's $37.5. Or you can buy 10 Qualcomm single stock futures. You're putting up 15%, so you're putting up $7,500. Or 10 Qualcomm September 35 calls. Remember, we want to go in the money. So we got the 35 calls at $3.10 or $3,100. So again, to figure out the premium, we're doing this in the ratio. It's 19% premium. That falls within the parameters. And we set it up that way.
So when you buy the stock, you can buy it on margin. You have to put up 37,000.
Yeah, you can. True. I mean,
so
yeah.
It's not a true comparison.
Yes and no. I mean, you're right. No, you can do it on margin and just subtract the interest that you're paying.
50% off.
Yeah. So whatever. I mean, you can do the math. So in this case, you've got 1,000 shares of Qualcomm. If you did margin, your gain on this is 16% instead of 8%. Or you got 10 Qualcomm single stock futures with a gain of 40%, or the 10 Qualcomm September 35 calls at 590, which is a gain of 90%. So using that ratio, you've got 90%, 40%, 8% if you're doing all cash, or 16% if you've got margin. Okay? Any questions on this? So now the rest of the examples that we'll do, I don't have all those comparisons, but you can kind of think of it that way, Tim. Yeah, I mean, I don't do the same strategy on futures on a swing basis. I do a modification of it. I am a big proponent of buying pullbacks to the ADMA, but the first problem is, okay, if you buy a pullback to the ADMA on the Dow at 10,000, well, what's an 8% target? 10,800. Okay, you could be in that trade for like a year. But it is reasonable to say, I'll say I'll buy a pullback to the ADMA, and then I'll also start looking at simple support and resistance levels, Fibonacci extensions, and things like that. So I do a similar play in the futures. It's not the 4-8% thing isn't the same.
The premium price ratio, you want less than 30%, is that correct?
Yes.
You don't wait for the stock to take out the high of the previous day or something.
No, and it's interesting. One of my favorite books when I got into trading was, God, my mind just went blank. Jeff. He wrote the books. They were real popular in the late 90s on day trading and Cooper. Thanks, Jeff Cooper. What was the name of the book?
Hit and Run Trading.
Hit and Run Trading. Thanks.
Hit and Run 2.
He's got Hit and Run 2, and those are some of my favorite strategies. But I always, the research that I did is he'd always wait for like three down days and then buy the breakout of the down day. And for me with stocks, I was always willing to be a buyer on that last down day back to a moving average. Just my personality is like, hey, all these people are getting stopped out and freaking out. I'll come in and take the opposite side of that trade. But yeah, you could do it the other way.
Yeah, I think Dave Landry does it.
Yeah, they're both big proponents. You buy the pullback to the EMA, then put your trailing buy stop above that bar, and that's maybe a little safer. But again, to me, I like this. If you're right, you get a great entry price.
That's true. With a great entry price, you don't necessarily need to have it do anything.
Right, which is why I like it. Okay. All right. So another example. Here's on the short side. So on this, the weekly chart is down. You had a daily uptrend coming up here. We cross back over. Once we cross, we get a sell below this level. So what am I doing? I want to short the first rally back to the ADMA. Happens the next trading day. I put up my 4% stop, 8% target. It's kind of interesting here. We sell off, come back, rally hard, gap down, sell off, and you're out. And you can just keep on going. Short again at the ADMA, out at the target, short at the EMA. In this case, got stopped out, 4% stop. Once we come back below, you can short it again, out at the target, and so on. So in this case, you've got 4 trades. 3 of them were winners. 1 got stopped out. I'm gonna find one that's a lot of explaining, but you guys get the idea, I think, at this point. Sure. Unless you really want me to go through each one. Okay.
You look at the whole universe of stocks that have single stock futures, like the weekly charts.
Yes.
To start to define the stocks that are doing this.
Yeah, I mean, for me, it doesn't take me that long because you can just scan through the charts. But it's pretty easy to write filters like, okay, show me all weekly charts where the 8 EMA is above the 21 EMA. Okay, there they are. then of that, find me all the daily charts that where the 8's trading below. Okay, now you've got your watch list when those turn higher, and you can actually refine it more. Me, I'm just kind of a stock chart junkie, so I actually physically like to look at them, and it helps me get a feel of the markets. But you can do it where it's filters and automatic.
The other day you talked about swing trading when a daily squeeze fired off on the S&Ps or something like that.
Right.
Do you have any other general approaches that you like that?
For the futures?
Yeah.
Yeah, I mean, one of the things that we talked about yesterday is when the squeeze fires off, that's what the first thing I'm doing is I'm trying to buy a pullback to the ADMA. You know, we got a squeeze long, I'm trying to buy that pullback to the ADMA and then stay in it until the squeeze loses momentum. So that's kind of a variation of this trade on the futures. The other thing, though, is that if the stock market's uptrending and there's not a squeeze play, I can buy a pullback to the ADMA and then just use simple resistance levels or Fibonacci extensions as my target. So that's kind of what I do with there. Like right now, I'm long the Russell. We got long Friday at 662. What's the Russell doing right now?
I don't know.
At ER2?
I don't know. I don't trade the Russell.
Well, you did last Thursday.
You're not Thursday.
It's 671 even.
How far is it up today?
It opened at 664 and it closed at 671.
So the Russell's, that's good. I mean, the Russell's, did it hit?
Wait, there's a gap. You want a 24-hour chart?
Yeah.
So it's micro style.
Oh.
Was it got 24.99?
So right now in the Russell, I got in. Okay. So on the Russell, I bought a pullback to the ADMA, and I've got an open target right now because I just want to give it a few days just to see, and then I'll start going in and putting in some targets on it.
But John, and you're willing that once you set this target, which is a price on your option purchase, you're willing to let it run as long as the option has life?
Yes. Yes. So what'll happen, okay, that's a good question. Okay, let's say we're in one of these plays. You've been in it for 3 weeks, and now it's options expiration day, and your stop or your target's not hit. Usually by noon on that day, I just get out of the option at the market, and then potentially you could roll over at that point and get a new one, or just look at the next setup. And that does happen with that does happen with the option and the single stock future.
But you're not interested in trying to save price or premium or anything like that during the run. I mean, if you've gone out to the next contract, which is maybe 3 months out, I mean, it's a long time to hold it if it's not working.
Yeah, and the thing about the options too, and the reason I play the closer, there's two reasons I play the closer month contracts. One, generally my trades are pretty short term. I mean, usually, more than 2 or 3 weeks is kind of rare that it's going to last that way. By that time, I've either been stopped, my trail's been hit, or I'm at my target. But also, the options that are closer have smaller premium amount. You go out a couple of months, sometimes it's like your premium gets really jacked up, and so that's part of the reason too. Did I see another hand? Or just somebody was ordering a beer?
Could you take the daily squeeze play and instead of exiting on receding momentum, exit on the pullback to the 21 EMA with the idea of possibly staying in the trade longer if the trend continues and giving back a little for the sake of staying with it?
I think, okay, if I understand, okay, you're saying you get in on the squeeze play and then just use the 21 EMA as a trailing stop regardless of when the you could. I have found that when the squeeze kind of loses momentum, so does the market. I'm a big proponent of we saw remember the squeeze play that had like the 67 points or something like that in that? As long as the market has momentum, it's going to stay in a squeeze. And once it loses momentum, the chances are pretty good that it's going to roll over and hit that 21 EMA. So it's a good idea. I found that once the squeeze loses momentum, it's kind of like, okay, this is done, next play. Okay, I'm going to show you a couple of examples that don't have that many numbers on them. Ah, yes. Here's Cephalon, same thing. We get the close below with the cross below. Here, next day we rally. We've got a limit order to short at that level. At this point, we're up 4%, so now we're going to use the 21 EMA as a stop, and we come down and hit the target. And that took what? That was like you're in that for 2 weeks.
Now, using the 21 and 8 as opposed to any other moving averages, is it a matter of experience or back test?
But yeah, experience. I've used other ones. For some reason, the 8 and the 21 seem to work the best. But does it, Could you use the 9 and the 20 and get similar? Yeah. But I don't. It's the main thing is the fast moving average and a slow moving average, and I found that I'm pretty comfortable with the 8 and the 21.
The 1 is the entrance, the 3 is the target. What's the 2? What's the 2 mean?
Means you're up 4%, time to move the stop.
Do you require any number of pullback days before you get into this trade?
No, good question. No, I don't.
But you don't have a resting buy limit order at the 80 EMA for every stock that's marching up.
Well, just the one. I mean, I'm not going to play like 100 of these at the same time. I mean, they're usually like out of my universe of 120 stocks that I'm looking at. There may be 5 or 6 setting up. So I'll have. I mean, I could have 5 or 10 limit orders in all at one time. None of them get hit that day, and then the next day, I open up my computer and it's like I got to adjust all the limits based on where the ADMAs ended up that day. Oftentimes on this strategy, you got a lot of bids out there and a lot of offers just waiting for them to get hit.
But my point is, you identified the chart in the first place because the relationship between the weekly EMA averages and then and the relationship on the daily.
Right. Yeah. Well, no. It's really the weekly that drives it. When the weekly is higher, okay, that's great. Now I'm going to go try to find daily charts that are lower, and then waiting for them to turn higher.
Okay, and the daily chart is lower. You mean that the EMA is lower?
Right.
Okay. So there has been some sort of sell-off.
Yeah, and that's what I'm looking for. I'm looking for, like, if I'm going long, I'm looking for a sell-off on a daily chart that is going against an uptrend on a weekly chart. Right. Okay.
Do you step in front of the EMA as well?
Like, what do you like?
You jump in early.
Oh. If the EMA is at $20.10, I'm going to put my bid like at $20.20, a little bit in front of it. There's not like a dime or so, just right around there. Okay, so here's an example of Goldman Sachs. You can see at this point here, the ADMA is crossed higher. Goldman Sachs is above. You put your order to buy the pullback. Now, Goldman Sachs pretty choppy here. You're actually in this trade for a while. At this point, number 2, you're up 4% in the trade. So now you move up your stop to the trailing 21 EMA, and you can see here it actually gets hit. So in this case, you're up at $3.30 for 3.76%. So that's an example of getting hit on a trailing stop.
Quick money management question.
Yep.
When your trading plan or your business plan for stuff like this, you are buying the same number of options contracts as you would buy stock. So you're not over leveraging.
Oh yeah, that's a good question. I mean, generally what I like to do with like options contracts is I want to put more. It's about 8 to 15% of my portfolio in one options contract. So if you've got a $100,000 portfolio, it's allocating about $15,000, $10,000 to $15,000 for one position.
When you say one options contract, you mean one stock's in the setup?
Yeah, I mean one play like that. Yeah. Anyone? The other thing I found that's kind of neat about this play is that you will sometimes get into stocks, stocks that have news. A lot of times if somebody knows something's going to be happening in a stock, it's going to get bid up and you don't know why. So sometimes you'll be in a play and just boom, you get the gap up and you're out. I mean, this instead of 8%, this was 13.34% on that in terms of the stock movement. So obviously stuff like that with options and things like that works well, and that's both on the upside and the downside. Obviously doesn't happen every time, but surprisingly, when you're in a stock that's moving like that, when nobody knows why, you're already getting into it before the action takes place. Now, in a stock like Tizu, how this works is generally you'll get into this trade. Okay, here we cross, bid, get filled. When you get filled here, out the next day. Bid, get filled, out the same day. Bid, get filled, out 2 days later. Bid, get filled, out the next day. Bid, get filled the same day, and then you get exited the same day too. That's pretty typical of what happens on a volatile stock like a Tizu, Taser, Google, and things like that. Sure, I mean, yeah, you could have gotten in here and just used a trailing stop and made a lot of money, but you never know when the stock's going to roll over or when it's going to be out and stuff like that. I mean, I'll take an 8%, 8%, 8%, 8%. I mean, you get enough of those, it actually adds up. Now, Tizu is an example of a stock that didn't have options on it, and it didn't have single stock futures on it. So you have no choice but to play it in the stock. All right, so at this point, we're done with today, unless you guys have any other questions. Does everybody understand what we're doing now?